Imagine everyone around you saying, "This currency is finished." You delay a shipment. You hold off on signing a new contract. You wait for the big crash you've been told is coming. And then, the chart goes the other way. If you run a business, send money abroad, or just follow economic news, you've probably seen that pattern. A currency everyone expects to fall, and then it doesn't. At least not for a while. It crashes on day one, then somehow climbs back and even looks strong on the chart. In the last few years, that story has shown up more than once. The Russian ruble, after the invasion of Ukraine. The Mexican peso, when the Federal Reserve pushed interest rates higher. The Chinese yuan, slowly taking a larger slice of global payments. When that happens, it is not only traders who are caught off guard. Exporters, workers, even governments build plans on a picture that turns out to be incomplete. Shipping schedules, hiring, debts, all tied to a story about where a currency must go. This episode is a casefile. We're not guessing the next move. We're asking a quieter question. What stopped the collapse everyone was so sure about? Loop A is our first question. What was the trigger everyone watched, and why did it mislead them? Loop B. What invisible counterforce held some of these currencies up? Loop C. What is the one variable almost no forecast screen shows? We'll treat this like an investigation. Different currencies, different shocks. Same pattern, predicted weakness, unexpected strength. We're looking backward, not forward. No trading tips, no migration advice. Just mechanics, what happened, in which order, and through which pipes. Now our guide through this story is not a hedge fund manager. It's someone closer to the ground. Meet Rahim, 28. He runs a small textile export business in Dhaka. His invoices to foreign buyers are in dollars. His rent, his fabric, his workers' wages are in Dhaka. His biggest headache lives on a tiny FX ticker at the top of his phone. Last year, almost every news alert he saw said that one of his partner countries' currencies was about to crumble. Commentators called it unsustainable. Forecasts showed steep lines pointing down. Rahim did what a cautious person does. He delayed a shipment. He pushed a contract into next month. He waited for the big fall. It never came. The currency he was told was doomed bounced back and for a while even looked strong. Relief, yes. His invoices still got paid, but also a new kind of fear. If he paused business because of a picture that turned out to be incomplete, what else is he missing? He doesn't want a secret trick. He wants to know why, so that next time, even if the future is still uncertain, he can at least ask better questions. To answer him, we'll follow a chain. First, the prediction machine, the way big forecasts are built. Second, the hard barriers, rules and controls that can hold up a currency. Third, the trade corridors, the orders and factories that keep money flowing. Fourth, the payment rails, the systems that move money across borders. Fifth, the obligations that lock people into using a currency for years. Each link gets one chart, one example, and one small mental tool you can keep. Along the way, we'll come back to our three questions, Loop A, Loop B, and Loop C, and we'll only close them once the casefile feels complete. Let's start with the prediction machine. When people talk about where a currency is heading, they are usually leaning on a model. It may be a formal one inside a bank or an informal one in someone's head, but most of them use similar parts. Interest rates, inflation, growth, government debt, politics. A catch-all called risk sentiment. Put those into a chart and you get something that feels very solid. A cone pointing up or down with lines for best case, base case, worst case. If the cone points down, it feels like the future is already written. If enough people repeat that picture, it starts to sound less like a forecast and more like a fact. On the screen, you can imagine forecast tables about the Russian ruble in early 2022, after the invasion of Ukraine. Many people expected severe weakness. At the same time, many expected emerging market currencies like the Mexican peso to struggle as the Federal Reserve raised interest rates. In this period, data suggests that some of those expectations were wide of the mark. The ruble later became one of the year's best-performing major currencies against the dollar. And during the Fed's tightening cycle, the Mexican peso appreciated significantly versus the dollar, while many other emerging market currencies weakened. The forecast cones pointed one way. The actual lines on the chart went somewhere else. Here is our first micro-win. When you see a confident forecast, first ask, emphasis, which pipes does this model ignore? Lupa lives here. In our casefile, the trigger everyone watched was a forecast picture built from interest rates, inflation, and headlines. We'll come back to why that picture misled so many people. Now the second link, the hard barriers. For this, we open the ruble file. After Russia's 2022 invasion of Ukraine, the ruble crashed. It fell to record lows against the dollar. For a moment, that seemed to confirm the forecast cones. Sanctions, isolation, fear. The story felt simple, but if you fast forward on the chart, something odd happens. Over the rest of the year, the ruble climbs back. By some measures, it ends up being one of the best performing major currencies against the dollar in that period. From outside, that can look like a miracle. A sanctioned economy, yet a strong currency. Inside the casefile, it is less mystical. Analysts point to a set of hard rules, capital controls, limits on how much foreign currency residents can move out, requirements for exporters to convert foreign earnings into rubles, and a collapse in imports that meant fewer dollars were needed to buy goods from abroad. In this period, data suggests that much of the ruble's strength came from these measures rather than from optimism about the underlying economy. The walls changed who could buy foreign currency and in what quantity. Here's the fear for someone like Rahim. He sees the same chart without the detail. A weak ruble, then a strong one. He might think, maybe the crisis was exaggerated. Maybe this system is stronger than people say. The relief is that there is an explanation. The controls and the fall in imports reduced demand for foreign currency. They created pressure for exporters to sell dollars and euros and hold rubles instead. The control comes from a small rule of thumb he can keep. When you see a surprisingly strong currency under heavy sanctions, look for walls. What are people allowed to do with their money? What are they forbidden to do? Micro-win. A strong exchange rate can mean stress is trapped inside the system, not that the system is healthy. Loop B shows its face here. The hidden counterforce holding the ruble up was not optimism. It was rules. Let's move to the third link in the chain, trade corridors. For this, we turn to the Mexican peso. When the Federal Reserve started lifting interest rates, many economies that borrow in dollars felt the strain. Higher U.S. rates can mean capital flowing back into the U.S., leaving emerging markets vulnerable. On paper, a lot of currencies in that group looked exposed, but the Mexican peso did not follow the common script. During this tightening cycle, while many emerging market currencies weakened, the peso appreciated notably against the dollar. In the same period, analysts observed another shift. Mexico strengthened its position as a key trading partner for the United States. Some research shows Mexico overtaking China as the largest U.S. trading partner by value. Supply chains, after years of stretching across oceans, started to shorten. Factories and orders moved closer to the U.S. border. For many businesses, higher U.S. interest rates meant fear. Our currency will sink. Everything we import will get more expensive. But Mexico sat in a different place on the map. Trade orders were moving toward it, not away. Rahim watches this part of the casefile and feels a familiar insecurity. He remembers a moment when he delayed a quote because everyone said a partner currency would fall. He never saw a map of where factories were actually moving. He only saw the interest rate story. Now he sees the map. Trucks at the border, ports, new plants, the quietly rising trade lines between the U.S. and Mexico. No one showed me this picture, he thinks. The explanation gives him relief. There was more to the peso's strength than a mysterious market mood. Stronger trade links meant steady demand for pesos to pay wages, suppliers, taxes, and local costs linked to those new orders. The control comes from another small mental tool. Don't just ask, what are rates doing? Ask, where are the orders flowing? Micro-win. If new factories and contracts are marching into a country, that country's currency is plugged into a fresh stream of demand. Loop A starts to close a little. The missing link in some forecasts was that they gave more weight to interest rates and less to shifting trade corridors. Now the fourth link, the payment rails. This is where the Chinese yuan enters the casefile. When people talk about global currency power, they often jump straight to reserves or big political ideas. But there is a simpler question that matters for daily life. In which currency are payments actually made? Here, data show a clear change. In global payment systems, the share of payments made in Chinese yuan roughly doubled in 2023 compared with the previous year. By one measure, yuan payments moved from just over 2% to a little over 4% of global transactions captured in that network. That is still far below the dollar and the euro, but it was enough to overtake the Japanese yen's share in that specific dataset. Inside China's own cross-border flows, the shift is even more visible. Within a few years, the yuan moved from being used in around a quarter of China's cross-border payments and receipts to more than half. Again, the dollar and other currencies remain important, but the share of transactions done directly in yuan has grown strongly. At the same time, China has been expanding the infrastructure that supports these payments. The Cross-Border Interbank Payment System, or CIPS, has added participants over time. Banks in regions such as Africa have become direct clearing points for yuan transactions. That allows some firms to settle trade in yuan without routing every payment through the traditional dollar-centric correspondent network. For an exporter like Rahim, a new payment rail can sound risky. What if the money gets stuck? What if the system is turned off? For larger firms and institutions, smoother rails can be a reason to use a currency more often, even when headlines about that country are tense. Lower fees, faster settlement, fewer steps. The micro question Rahim can ask is simple. How does the money move? Through how many banks, at what speed, not just which flag is on the note. Micro-win. Payment rails are like roads. If a road is smoother and shorter, more trucks will use it, even if drivers complain about the weather. This brings us close to Loop C. Many forecasts talk at length about interest rates and debt. Fewer put front and center the places where payments actually clear each day. Not just who holds a currency as a reserve asset, but who needs it to settle bills now. We've seen forecasts, walls, trade corridors, and rails. The last link in our chain is quieter, obligations and networks. You do not need a research paper to understand this one. It lives in everyday life. If your lease is written in one currency, you need that currency on the day rent is due. If your loan, your supplier contract, and your workers' wages are in that same currency, there are several dates on the calendar when you cannot simply opt out. Now stretch that idea across an entire economy. Governments with bonds issued in a currency. Companies with long-term supply contracts. Banks with structured products. Once enough people sign that kind of contract, they are tied into using that currency for years. They might complain. They might try to hedge. But on payment day, they still need to get hold of those units. On the screen, imagine a simple network graph. Each dot is a firm, a bank, a government office. Each line is an obligation written in a specific currency. A shock hits. Headlines shout about collapse. Some dots try to run for the exits. But many lines on that graph do not disappear overnight. For someone like Rahim, markets can look random. Big moves, scary headlines, sharp reversals. The relief comes when he realizes there is also a quieter map, obligations that keep a certain level of demand alive. Not forever, not at any price, but for longer than a simple forecast cone would suggest. The control is a small question he can ask when he hears, "This currency is doomed." Who is already committed to paying in it for the next few years? Loans, leases, trade deals, taxes. Micro-win. A currency can stay stronger than expected as long as enough people are locked into using it, even if many of them would rather not be. Loop A now closes. The collapse trigger everyone watched, interest rates, inflation, politics, was real but incomplete. Loop B closes too. The silent counterforces in our casefile were not mysterious good vibes. They were walls set by policy, trade orders still flowing, payment rails that got smoother, and obligations written years in advance. Loop C closes as well. The variable that rarely appears at the top of a forecast screen is obligation-driven demand. How much of a currency is needed right now to keep existing contracts functioning? Rahim looks back at the moments that scared him. No one in his WhatsApp groups talked about capital controls, trade corridors, or payment systems. The conversation stopped at headlines. Now, he has at least a language to ask follow-up questions when he speaks with his bank or his buyers. He does not change his investments in this story. He does not discover a shortcut. What he gains is a clearer sense of what he doesn't know, and a small set of questions that make the next forecast picture feel less like fate and more like one piece of an incomplete file. Before we close, we need to deal honestly with objections. One objection sounds like this. Isn't this just about interest rates and carry trades? If a country pays higher rates, investors want that yield. Of course, the currency can be strong. That is an important point. In this period, higher domestic interest rates did play a role in how some currencies performed, especially in cases like the Mexican peso. Other factors like commodity prices and fiscal policy also mattered. We are not replacing those explanations. We are adding plumbing rules, flows, and rails alongside them. Another objection. These episodes might be temporary. The ruble, the peso, the yuan, all of them could weaken later. Doesn't that make this whole casefile a distraction? That concern is also fair. The paths of these currencies can and do change over time. This episode is a snapshot, not a prediction. We are asking why the collapse many people expected did not happen in the way or at the speed they imagined. A third objection. The yuan's share of global payments is still small. Doubling from a little over 2% to a little over 4% doesn't change who really dominates the system. That is true. In the payment systems we discussed, the dollar and the euro are still far ahead. Our point is narrower. Even small changes in payment shares can matter for the people and regions most directly involved. They are part of the plumbing story, not the whole story. It might sound, at this stage, as if every episode has a neat hidden explanation. Real life is messier than that. The available evidence is patchy. Some flows run through opaque channels. Correlation here doesn't prove causation, but knowing which pieces are often missing, from capital controls to trade flows to payment rails, keeps you from treating any single story as the whole picture. Micro-win, you don't need to pick a side in currency debates. You can simply watch which explanations mention the plumbing and which ones ignore it. If you work in a business, a public office, or you just like to think in systems, here is a 7-day observation exercise. This is not a strategy. It will not tell you what to buy or sell. It is a way to see the pipes behind the charts. Day 1. Pick one currency that is in the news. Maybe it is your own. Maybe it belongs to a major trading partner. Write down the loud reasons people give for where it is going in the next few months. Rates, politics, fear, hope. Day 2. Look for walls. Search for policies, capital controls, sanctions, special rules. Note one rule that limits what residents or companies can do with that currency. Day 3. Search for corridors. Find one map or article about trade flows linked to that currency, exports, imports, or supply chains being relocated. Day 4. Look at the rails. Search how cross-border payments move in that currency. Is there a special payment system or clearing bank that keeps those flows running? Day 5. Think about obligations. List 3 types of contracts that are likely written in that currency. Loans, leases, trade deals, taxes. Any commitments that stretch beyond this year. Day 6. Actively look for a counterpoint. Read one serious argument that says, none of this plumbing matters very much. Fundamentals explain almost everything. Notice which data that argument uses and which parts of the system it leaves off-screen. Day 7. Draw a small casefile. It can be on paper or a tablet. Put the currency in the center. Draw arrows from walls, corridors, rails, and obligations into that center. No prediction, no target price. Just a map of how money actually moves through that system today. By the end of the week, you will not know where the chart goes next, but you will know why it sometimes refuses to follow the script. We have seen currencies that seemed destined to fall but didn't, at least for a while. We opened forecasts, then peeled back layers, rules that blocked exits, trade corridors that redirected orders, payment rails that grew wider, and obligations that kept demand alive. The casefile answer is simple and a little uncomfortable. Sometimes, strength is a sign of how tightly people are trapped into using a currency, not how much they love it. In the next episode, we'll flip the question. Not why didn't the collapse happen, but why do some crises arrive exactly when the numbers look calm? We'll open the casefile of an economy that looked steady until it suddenly wasn't.